Preparing for a financial analyst at PSEG interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to work at PSEG. I am an analytical finance professional who enjoys turning operational data into decisions. PSEG interests me because its businesses combine essential service reliability, significant capital investment, regulatory complexity, and an evolving clean energy strategy. My experience with forecasting, variance analysis, and Excel-based modeling would help explain performance and support disciplined resource allocation. I also value the company's public service impact. This role appeals to me because strong financial analysis directly supports grid reliability, customer value, and long-term energy transition decisions. While answering, connect your analytical background to PSEG's utility operations, regulated environment, infrastructure investment, reliability mission, and commitment to cleaner energy. Show preparation, commercial awareness, and a specific reason for choosing PSEG. Question 2. What do you know about PSEG's business? PSEG is a diversified energy company centered on public service electric and gas, New Jersey's regulated electric and gas utility, alongside PSEG Power and related operations. The business requires reliable infrastructure, substantial capital spending, regulatory approvals, and careful management of commodity and market exposure. I would expect financial performance to reflect approved rate structures, customer demand, weather, fuel costs, generation economics, and investment execution. That combination makes PSEG financially distinctive from a typical industrial company. Make sure to cover PSEG's regulated utility and competitive energy activities, electricity and gas operations, New Jersey footprint, infrastructure responsibilities, and the financial implications of regulation, capital intensity, and energy market exposure. Question 3. Why is financial analysis different for a regulated utility? Regulated utility analysis must incorporate both financial results and the regulatory framework governing recovery. A utility generally earns an approved return on its rate base, while certain prudent costs may be deferred and recovered through future rates. Therefore, I would analyze earnings, cash flow, capital deployment, rate case outcomes, and regulatory balances together. I would also distinguish temporary accounting timing from permanent economics. Reliability and affordability matter because financial performance cannot be separated from customer and regulatory outcomes. In your answer, discuss allowed returns, rate cases, cost recovery, regulatory assets and liabilities, capital programs, service reliability, and the difference between accounting earnings and economically recoverable costs. Question 4. Walk me through how the three financial statements connect. The income statement calculates net income, which flows into retained earnings on the balance sheet. Non-cash expenses such as depreciation reduce earnings but are added back in operating cash flow. Capital expenditures increase property, plant, and equipment and reduce cash, while debt issuance increases both liabilities and cash. Working capital movements connect balance sheet changes to cash flow. Finally, ending cash from the cash flow statement must agree with the balance sheet, providing an important model control check. Be sure to mention net income, retained earnings, working capital, depreciation, capital expenditures, debt issuance, cash balances, and the balance sheet checks required to validate an integrated model. Question 5. How would you build a monthly forecast for PSEG? I would begin by separating revenue, operating expense, capital spending, and financing drivers. Revenue could reflect customer counts, usage, weather, approved rates, and generation or market prices. Expenses would include fuel, purchased power, labor, maintenance, and other operating costs. I would build monthly seasonality, document assumptions, and reconcile the forecast to actual results. Each cycle, I would investigate variances, update driver assumptions, and communicate a concise bridge explaining what changed and why. Focus on operational drivers, historical seasonality, customer demand, weather, rates, fuel costs, generation output, headcount, capital spending, assumptions ownership, and variance-based forecast updates. Question 6. What is a rate case, and why does it matter financially? A rate case is the process through which a regulated utility seeks approval to adjust customer rates based on its cost of service and required return. The analysis typically considers rate base, operating costs, depreciation, taxes, reliability investments, and an authorized return on equity. The outcome affects revenue, cash flow, and the ability to fund future infrastructure. I would monitor filing assumptions, regulatory milestones, settlement terms, and any gap between requested and approved recovery. Discuss the utility's request for rates, prudently incurred costs, rate base, allowed return, customer affordability, regulatory approval, timing risk, and effects on revenue, cash flow, and future investment capacity. Question 7. How would you explain a favorable or unfavorable budget variance? I would first quantify the variance against both budget and prior year, then decompose it into volume, price, timing, mix, and one-time effects. For example, higher maintenance expense may be unfavorable versus budget but reflect a planned outage moved forward, making the annual forecast unchanged. I would confirm the cause with operational owners, assess whether it is recurring, update the outlook if necessary, and present management with a clear action or monitoring recommendation. Mention amount and percentage variance, volume, price, timing, mix, weather, one-time items, controllability, root cause, forecast impact, and a recommendation rather than merely reporting the number. Question 8. How do capital expenditures affect a utility's financial statements? A capital expenditure initially reduces cash and increases property, plant, and equipment when the project qualifies for capitalization. Depreciation then reduces earnings over the asset's useful life, while financing may create interest expense and debt balances. In a regulated utility, eligible investment can also increase rate base and potentially support future revenue recovery. I would test capitalization policy, project timing, budget performance, and expected operational or regulatory benefits rather than treating all spending as equally valuable. Cover cash outflow, capitalization to PP&E, depreciation, financing needs, rate base growth, regulatory recovery, operating benefits, and the distinction between capitalizable projects and repair or maintenance expense. Question 9. What is working capital, and which items would you monitor at PSEG? Working capital measures operating current assets less operating current liabilities and helps explain near-term liquidity. At PSEG, I would monitor customer receivables, collections, fuel and materials inventory, accounts payable, accrued payroll, taxes, and other regulatory or customer-related balances. Weather, billing cycles, commodity prices, and planned outages can create meaningful seasonality. I would analyze both the balance and the cash conversion drivers, then incorporate expected timing into the liquidity forecast. Explain operating current assets and liabilities, receivables, payables, inventory, accrued expenses, customer deposits, collections, seasonal demand, and how working capital movements affect liquidity and cash forecasting. Question 10. How would rising interest rates affect PSEG? Higher rates can increase interest expense when debt is refinanced, raise required returns for capital projects, and reduce the present value of future cash flows. They may also pressure customer affordability and influence regulatory discussions about financing costs. I would review debt maturities, fixed versus floating exposure, hedge positions, capital timing, and rate recovery mechanisms. The impact would differ across businesses, so I would separate regulated cost recovery from competitive market earnings and update sensitivities accordingly. Address debt refinancing, interest expense, project hurdle rates, cash flow, valuation, customer affordability, regulatory recovery, hedging, and the different impacts on regulated and competitive businesses. Question 11. Describe a financial model you have built or would build for an energy company. I would build an integrated model that forecasts customer demand, generation or purchased power, rates, operating costs, capital expenditures, depreciation, financing, and cash flow. Historical data would establish seasonality and operating relationships, while separate assumption tabs would support scenario analysis. I would include checks for balance sheet integrity, circularity, missing inputs, and unusual variances. The model's output should answer a decision, such as funding a project or assessing earnings sensitivity, not simply produce detailed spreadsheets. Mention model purpose, operational drivers, assumptions, historical calibration, scenario analysis, outputs, controls, documentation, and how you would keep the model useful for decision makers rather than overly complex. Question 12. What Excel functions and techniques are most useful in financial analysis? I regularly use SUMIFs, XLOOKUP, index match, IFERROR, pivot tables, conditional formatting, and sensitivity tables. For a forecast, I would use structured assumptions, consistent formulas, and clear input, calculation, and output sections. I also rely on checks that flag missing data, balance sheet breaks, and unexpected changes. Before sharing a file, I trace key formulas, test edge cases, verify totals against source data, and make the model understandable to someone who did not build it. Be sure to mention SUMIFs, XLOOKUP or index match, IFERROR, pivot tables, conditional formatting, data validation, charts, sensitivity tables, keyboard efficiency, and model auditing discipline. Question 13. How would you analyze PSEG's free cash flow? I would start with operating cash flow, then subtract capital expenditures to calculate a practical free cash flow measure. I would separate recurring maintenance investment from growth or regulatory projects and identify working capital, tax, and storm cost timing effects. I would also distinguish underlying cash generation from proceeds on asset sales or financing activities. Comparing free cash flow with debt maturities, dividends, and planned investment would show whether the business can fund priorities without increasing leverage. Discuss operating cash flow, capital expenditures, working capital, asset sales, financing separately, maintenance versus growth capital, regulatory timing, and why cash generation may differ from net income. Question 14. What financial metrics would you monitor for utility? I would monitor revenue and EBITDA growth, operating expense performance, operating cash flow, capital expenditures, free cash flow, debt to capital, and interest coverage. For a regulated utility, I would add rate base growth, authorized versus earned return, regulatory balances, customer counts, usage, and reliability indicators. I would not view metrics in isolation. Strong earnings with weak cash conversion or delayed capital execution may signal risk. The best dashboard combines financial, operational, and regulatory indicators. Include revenue and EBITDA trends, operating efficiency, allowed versus earned returns, cash flow, capital spending, debt ratios, interest coverage, reliability measures, customer growth, and regulatory performance. Question 15. How would weather affect PSEG's financial results? Weather can materially change electricity and gas demand, particularly through heating and cooling load, while severe storms can increase restoration and maintenance costs. I would compare actual conditions with normal weather, isolate volume effects from pricing and customer growth, and assess whether storm costs are recoverable or timing related. For forecasting, I would use normalized assumptions alongside actual scenarios. This prevents management from mistaking a temporary weather benefit or disruption for a structural performance change. Cover heating and cooling demand, gas and electric volumes, storm costs, restoration spending, seasonal comparisons, normalization, regulatory recovery, and the importance of distinguishing weather from underlying customer trends. Question 16. How would you assess a proposed grid modernization project? I would evaluate the project's reliability, resilience, safety, capacity, and customer benefits before focusing on returns. Financially, I would forecast construction spending, operating savings, depreciation, financing, potential rate recovery, and terminal benefits, Then calculate NPV and IRR using an appropriate discount rate. Sensitivities would include cost overruns, delays, interest rates, demand, and regulatory outcomes. I would compare alternatives and clearly identify benefits that are difficult to monetize but essential to the investment case. Focus on strategic need, reliability and resilience benefits, capital cost, operating savings, regulatory recovery, NPV, IRR, sensitivities, execution risk, customer impact, and alternatives. Question 17. Explain NPV and IRR, and when you would use each. NPV discounts a project's future cash flows and subtracts the initial investment, showing value created in today's dollars. IRR is the discount rate that makes NPV equal 0 and provides an intuitive percentage return. I prioritize NPV for mutually exclusive projects because it measures absolute value and avoids some IRR distortions. I use IRR as a supporting metric, alongside payback and strategic considerations. Both require realistic cash flows, timing, discount rates, and sensitivity analysis. Define both measures, emphasize time value of money, explain value creation and reinvestment assumptions, discuss mutually exclusive projects, and mention sensitivity analysis and discount rate selection. Question 18. How would you evaluate a project with negative NPV but important reliability benefits? A negative NPV does not automatically mean the project should be rejected, especially for essential infrastructure. I would first verify the assumptions and quantify reliability, safety, resilience, avoided outage costs, compliance, and customer benefits as thoroughly as possible. I would compare the project with lower-cost alternatives and assess the consequences of delay. Then I would present the financial return separately from strategic and regulatory benefits, allowing management to make a transparent risk-informed decision. Mention safety, reliability, resilience, legal or regulatory obligations, unquantified benefits, customer impact, alternative costs, risk mitigation, and transparent separation of financial and strategic decision criteria. Question 19. What accounting issues are particularly relevant to utilities? Utility accounting requires close attention to regulatory assets and liabilities, plant additions, depreciation, asset retirement obligations, storm costs, environmental obligations, and impairment indicators. I would confirm whether costs meet capitalization or deferral criteria, understand the approved recovery period, and assess how treatment affects earnings and cash flow. I would also reconcile operational project records to the general ledger. Good analysis connects accounting outcomes to the underlying regulatory order and economic substance. Discuss regulatory accounting, plant accounting, depreciation, asset retirement obligations, storm costs, environmental liabilities, impairment, revenue recognition, and the importance of matching accounting treatment with approved recovery. Question 20. How would you investigate a sudden decline in operating margin? I would first validate the data and compare the decline with budget, prior year, and the same seasonal period. Then I would build a margin bridge separating volume, rate, customer mix, weather, fuel, purchased power, outages, labor, maintenance, and one-time items. I would speak with operating teams to confirm root causes and test whether they are temporary or recurring. Finally, I would update the forecast and communicate actions, risks, and confidence level clearly. Cover data validation, revenue and expense bridges, volume, price, mix, weather, fuel, purchased power, outages, labor, one-time items, peer context, and forecast implications. Question 21. Tell me about a time you found an error in financial data. In a monthly reporting file, I noticed a department's expense increase was inconsistent with its hiring pattern. I traced the source data and found that one invoice had been uploaded twice under different descriptions. I confirmed the issue with accounting, corrected the report, and documented a duplicate invoice check using vendor, date, and amount fields. The adjustment was modest, but the control prevented recurring errors and improved confidence in the management dashboard. Use a concise star structure, explain the control or analysis that exposed the issue, quantify the impact if possible, describe corrective action, and emphasize professional communication and prevention. Question 22. Describe a time you had to meet a tight deadline with incomplete information. For a same-day forecast request, several operating inputs were unavailable. I identified the assumptions most material to the decision, used recent actuals and seasonally adjusted estimates for the remainder, and clearly labeled each assumption. I produced a base case and a downside sensitivity, then highlighted the information that could change the conclusion. After submission, I followed up with the business owners and replaced estimates with actual inputs, preserving both speed and analytical integrity. Explain how you prioritized material items, documented assumptions, used reasonable proxies, communicated limitations, performed quality checks, and followed up with a refined analysis after the deadline. Question 23. How do you communicate complex financial information to non-finance stakeholders? I begin with the business question and the conclusion, then explain only the financial drivers needed to support it. I use a simple bridge, chart, or scenario table rather than leading with accounting terminology. For example, I might explain that margin declined because lower demand and higher purchased power costs outweighed rate increases. I define technical terms when necessary, confirm the stakeholders' priorities, and provide supporting detail separately for anyone who wants to go deeper. Mention starting with the decision, using plain language, prioritizing material drivers, visual bridges, avoiding unnecessary technical detail, confirming understanding, and tailoring communication to the audience. Question 24. What would you do if an operational leader challenged your forecast? I would treat the challenge as an opportunity to improve the forecast rather than defend a spreadsheet automatically. I would ask which operational facts differ, review the source data and timing, and separate confirmed information from judgmental assumptions. If the leader provides stronger evidence, I would update the model and document the change. If uncertainty remains, I would present a range with clear drivers. My goal is an accurate, transparent forecast, not ownership of a particular number. Focus on listening, understanding the operational evidence, separating facts from assumptions, reconciling source data, testing alternatives, maintaining independence, and reaching a documented, transparent conclusion. Question 25. What questions would you ask us at the end of a PSEG financial analyst interview? I would ask which decisions this analyst role most directly supports and what success looks like during the first 6 to 12 months. I would also ask about the team's forecasting cadence, key business partners, systems and reporting tools, and the balance between recurring reporting and project analysis. Finally, I would be interested in how the team is evaluating infrastructure investment, affordability, reliability, and clean energy priorities. Those questions show curiosity about both the role and PSEG's broader mission. Be sure to ask about team priorities, first-year success, forecast and reporting cycles, business partners, analytical tools, development opportunities, current strategic challenges, and how the role supports PSEG's mission. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.